First thing I want to talk about investing, because I think that investing is complicated. I don't think it's taught anywhere. And it's arguably what everyone's told is the best thing to do with your money. And yet no one is really taught how to invest. This is going to be like a 101 level course here, really. When we talk about investing, you can invest into a number of different assets, but the one I'm going to be talking about here are called stocks. Everybody's heard the term stocks. What actually is a stock? Well, a stock is a piece of ownership of a publicly traded company, meaning you actually own a very, very small piece of a pie that is the company. So if you buy a share of Apple, you now own a small piece of Apple. And if Apple as a company does well and the evaluation of the company goes up, then your share price goes up, right? So that's what a stock is. And when you invest in stocks, you do so through a brokerage, which I'll talk about in a second. But essentially, stocks have historically been one of the best ways to make money in America. This is how the rich get richer. People who become millionaires, most of them do it through the stock market, and it's over a very long period of time. It's not a quick get rich quick scheme by any means, but when we talk about like retirement accounts and everything, it's the reason they can get to millions and millions of dollars by the time people retire is because stocks go up over time and compounding growth. But what's crazy is that 39% of Americans actually aren't even involved in the stock market at all, meaning they don't have any money in the stock market. So that's almost half, more than a third of Americans aren't receiving this beautiful thing that is just income from stocks. So when you're actually deciding to invest in stocks, there's a couple of different ways you can do it, right? There's individual stocks, which is what I just mentioned in the case of Apple. If you say, I want to go buy a share of Apple, that's buying an individual stock of Apple. Then there's things where I'm going to group them all together. They're a little bit different, but mutual funds, index funds, and ETFs, right? Essentially what these are is a basket of stocks, meaning that you have, if I put $100 into SPY, which is essentially a index fund that tracks the 500 largest companies in the United States, then that $100 is split across the 500 largest companies, and it's based on the valuation of those companies. So for example, if I put $100 in SPY, a certain amount of it will go to Apple, Google, etc. And then what's really cool about these is that it limits your exposure to individual companies. So when you invest in an index fund, then you are essentially buying a little piece of a bunch of different companies. And the example I like to use here is with Tesla, right? Tesla is a stock that has had a massive amount of growth over the past 5-10 years, right? Except it is very correlated with Elon Musk's public image. It can literally change based on how he tweets. And so that's a lot of exposure to a single thing. And so if there's a PR scandal and you're very heavily weighted in Tesla, then you can lose a bunch of money really quickly. Whereas if you just have a bunch of different companies under a single investment, right, which would be like an index fund, then you can reduce your exposure or risk to a single thing like that. That generally means that you won't see as high growth, right? You're not going to get 10,000x as if you were to go in penny stocks, but it's a lot more consistent. And when I talk about investing for the long term, which is what I personally do, that's what it is. I want something that's going to stably grow over a long, like decades, rather than something that might 100x or might go to zero, which is why I personally don't invest into individual stocks. I used to do this, and this was when I was, learning about investing and everything. And I actually got on Robinhood, and I ended up buying a couple $1,000s worth of a stock called Allbirds. It was a direct-to-consumer shoe company. And, I thought, it's going to do well. And a couple of my buddies, we thought we were doing DD, which means due diligence, that it was a good company. And it turns out that was wrong. And now I basically lost a couple $1,000s on a single shoe stock. Right. So that's why I don't recommend going into individual stocks. Something like 90% of people who pick individual stocks lose money. And it's even worse if you actually talk about day trading. So I want to make it very clear when I talk about investing, especially in the stock market, that is entirely separate from day trading. Day trading is essentially trying to buy and sell stocks or options, which I'm not going to go into. That's a bit more advanced in this video. I'm not going to talk about that. But you're trying to buy and sell stocks on a very short time frame, on the order of like days or even hours, to try and make a profit. So if something is at $100 and then it goes up to $101, then you sell, you made $1 profit, right? I'm against that because what a lot of people don't realize is that when you are day trading, somebody is on the other side of that trade. You are essentially competing with somebody and you are saying, I think that it's going to go up or I think it's going to go down. And the other person on the other side of that trade is saying, I think you're wrong. And when you're just an average Joe Schmo doing that, then you're competing against companies that have billions and billions of dollars. That is literally their only job, is to try and beat people like you or predict the market. There's something as well called being priced in, which is essentially that the stock market itself, when you look at a stock price, you might see like a news headline, right? Oh, this company has a PR scandal, for example, right? The current stock price already has that information and it's priced in. You are not going to be privy to information that the people who are essentially determining the price of that stock aren't. I don't care if you get a TikTok tip or you see an article or your buddy tells you something, oh, this company is going to do this because of that. All of that is already in the current stock price. And so basically, you're not going to have information that the people with billions and billions of dollars don't. Really, what you should be investing for and what I invest for is, okay, do I think that this is a good company that will grow over tens of years? And I don't even invest in individual stocks. So what I'm betting on is that, do I think the US economy will go up over the course of 10, 20, 30 years? And of course, that historically has always been true. That's the safest bet. There's another thing called dividends. Dividends are essentially, some companies will pay out dividends to their stakeholders, which means if I buy a stock, Coca-Cola, for example, has dividends. They can do two types of things with their profits. They can either reinvest those profits back into the business, or they can return it to their shareholders as sort of an incentive and saying, hey, thanks for believing in the company. And a lot of companies will pay out dividends. So you can either reinvest those dividends. They literally come as basically just money into your account. And then you can either choose to reinvest those dividends or just say, hey, give me the money that my stocks are paying me, kind of like passive income, if you want to call it that. If you reinvest your dividends, the S&P 500, it has averaged around like a 10 point something % rate of return every year, which is crazy. Now, it's important to note that it doesn't return 10% every single year, but it has returned an average of 10% over the entire lifetime. Some years, right, if you talk about like a recession, it may drop 40, 50%, which is obviously catastrophic if you're trying to retire right then. But that's why you build in other sort of risk toleration factors. There's a saying that you don't try and time the market. It's time in the market, not timing the market, is actually how the phrase goes. Because a lot of people will try and say, oh, but now it's a low, so I'm going to wait until it hits the bottom and then I'm going to buy. And then when it hits the top, I'm going to sell. You cannot predict the lows and the highs. Nobody can, right? Otherwise you'd be able to make an infinite money printing machine. So what's better is just to throw in money, and this is what I do, forget about it, and then over time, watch as it grows. And when it goes down, right, don't freak out, don't panic, right? A lot of people get emotional and oh, my investments are dropping, I'm going to sell my stocks, blah, blah, blah. Don't do that, right? Or at least I don't do that, because again, none of this is financial advice. I don't know how many times I have to say that. But essentially, when the time horizon that you can have is 10, 20, 30, 40 years, then those little valleys, if you look at a graph of the S&P 500, which we can put up, those little valleys are actually insignificant in the grand scheme of things. So how do you actually invest in the stock market, right? This is one thing where I think a lot of people aren't really taught this. It's actually quite simple. There's a couple really big brokerages, and I'm not going to tell you which one to use. A lot of people ask, oh, what's the best one? What's the best one? Really, they're all good. The really, really big ones are Fidelity, TD Ameritrade, Charles Schwab. And so what you'll do is you'll just go to one of those sites and say, hey, I want to open up an account. Open up an investment account. And there's different types of accounts that you can actually open up to investment. So I'm going to talk first about retirement accounts. In my opinion, this is what I focus on funding first because it's sort of the safety net, right? There's a couple of kinds in the United States. The most popular ones are the 401k. 401k is offered to you by an employer, and it is essentially a way for you to contribute towards your retirement, either pre or post tax. They will actually, a lot of companies will match up to a certain percentage of your salary. So how does this work? Well, if my company matches 5% of my salary, that means for every dollar I contribute up to 5% of my salary, my company will put an additional dollar into my retirement account. Now, that is 100% rate of return immediately. So this is a really, really good thing. All the retirement accounts I'm about to mention have a limit to what you can contribute at a government level. In general, as a rule of thumb, if the government is capping what you can contribute to something, that means they know it's very powerful. And usually it's for tax incentivized things. And so it's a really good idea to contribute towards your 401k. A lot of people talk about, oh, but I can't touch the money until I'm 59 and a half, which is true without penalty. But the odds that you're going to be above, like you're going to live to your 50s and 60s, you have almost a 90% chance to still be alive when you're 59 and a half, and you could start pulling out money. And so you owe it to your future self. If you do this right, you could have millions and millions of dollars in your 401k. Contribute up to the match is what I do personally. And that's one type of retirement account. In a 401k, you typically have less options to choose between the stuff you invest in. So usually in 401ks, you cannot pick individual stocks. Usually you pick a set list of funds that they offer as part of that employer with the, your trading platform or whatever it is. And that's one type of retirement account. It goes directly with your employer. The other types are called IRAs, which literally stands for individual retirement accounts. And then there's a Roth IRA. I'll explain the difference in a second. Individual retirement accounts, both Roth and IRA, you can just open one, right? With virtually any platform. What's really cool about these is that, again, there's a set contribution limit. And so in 2023, it's $6,500, meaning that the max you can contribute is $6,500. And then in an IRA, what you can do is it's tax deductible, meaning if I contribute $6,500 into an IRA, then I can subtract that amount from my taxable income. If I made $100K and let's say I'm taxed 33%, meaning that I would actually pay $33,000 in taxes. If I contribute $6,500 to an IRA, then I can say that my actual income was $93,500. So I only pay taxes on that, save some money. What's arguably cooler in my opinion, and what I personally contribute to, is what's called a Roth IRA. A Roth IRA is post-tax, meaning you can't do that tax thing I just mentioned, but it grows tax-free. Every dollar that is made in that account, you can take out after you're 59 and a half completely tax-free, which means if I continue to contribute as much as I'm contributing right now to my Roth IRA, I will literally have multiple millions of dollars that I can take out completely tax-free from my Roth IRA. There is a maximum income that you can contribute to a Roth IRA, which is around like $150,000 this year, I think. Anyways, I'm above that, but then there are ways to get around it. There's a strategy called the backdoor Roth IRA, which is essentially contributing to a traditional IRA and then converting to a Roth IRA. If you don't make above $150,000 a year, you don't have to worry about this. But if you do, that's something to look up. It's called backdoor Roth IRA. So those are the retirement accounts, right, that a lot of people do. And it's important to note that once you put money into one of these accounts, right, once you opened them up in Fidelity or whatever, you actually need to invest the money, right? An IRA is just the type of account, but you actually still need to invest the money once it's in that account. And that's where it comes, the decisions of individual mutual funds, those types of things that I talked about previously. That's where that comes in. But don't just leave it sitting in an account. There's a lot of people who will open up a Roth IRA, fund it, and then not invest the money. And then it just sits there and you get no benefit. I want to talk about one thing that's a bit advanced, which is a HSA, which is a health savings account, which is for people who are on a high deductible health plan. So this is health insurance, right? If you are on a high deductible health plan, then you can contribute to a health savings account. This is what I personally do, which has a maximum contribution limit of $3,800, I think, in 2023. And you can actually invest the money in there, which is really interesting. So what I do is I invest the money in my HSA, which essentially becomes another retirement account because it grows tax-free as well. And you have to use it for medical expenses up until a certain age, but then you can actually pull it out and use it for whatever. But that's a bit more advanced. You can look it up, contributing and investing in HSA. The last and arguably most common type of account is just a taxable brokerage account. This is when you just go to an account and say, hey, let me open up an investment account. And what this is it's an account where you can send money however much you want, whenever you want, and invest in whatever you want. But any money that you make in that account is taxable, meaning if I buy a stock for $1,000, it goes up to $2,000 and I sell, meaning I made $1,000, I would have to pay capital gains, which is the type of income on those $1,000. And there's a difference between short-term capital gains and long-term capital gains. Short-term capital gains is when you have a holding for less than a year. So if I bought that stock and sold it in under a year. Long-term capital gains is if I held it for over a year, and then the tax rate is much, much, much lower. This is something to focus on, especially if you are thinking about buying and selling stuff fairly quickly. But again, if you're just thinking about buying and holding for many, many years, then you'll really only have to worry about the taxes once you start selling out of your positions.